We are looking at Super Microcomputer Inc., trading under the ticker symbol SMCI. And as of this exact moment on Monday, December 1, 2025, the stock is changing hands at $33.37. We are seeing a downward intraday move of approximately 1.43%, with the stock struggling to find a solid floor near that $33 level. It opened slightly higher, but has faced consistent selling pressure throughout the morning session, currently sitting closer to its daily low of $32.59 than its high of $33.45. If you are watching the charts on your Fidelity mobile app or your interactive broker's trading screen, you are likely seeing a lot of red candles stacking up on the hourly view, signaling that the market is still very much in a prove-it-to-me mode with this company. Now, here is the immediate expectation that most people have when they see a chart like this. The narrative expectation is that Supermicro is a damaged asset, a company bogged down by forensic accounting scandals, auditor resignations, and a loss of trust that is arguably terminal. The prevailing sentiment is that where there's smoke, there's fire, and investors are fleeing to safer havens like Apple stock or Tesla stock to avoid the blast radius. But here is the reality that might surprise you, and this is the angle that forces us to look closer. Despite the massive cloud of uncertainty regarding their financials, the physical operational reality of Supermicro has not stopped. In fact, they are shipping products at a velocity that contradicts the imminent collapse narrative. While the boardroom is fighting an accounting war, the loading docks are reportedly full of their new air-cooled AI servers featuring AMD Instinct MI355X GPUs and Nvidia Blackwell architecture. The reality is that the AI infrastructure build-out is so aggressive that the market might be mispricing the sheer utility of Supermicro's hardware because it is too focused on the administrative chaos. The gap between administrative disaster and operational necessity is where the opportunity and the extreme danger lies. To understand why this price point of $33.37 is so contentious, we have to look at the immediate context of today's trading. The volume is heavy, already crossing 2.9 million shares in the first hour, which tells us that institutions are active. This is not just retail traders panicking on Robinhood. This is a battleground where large funds are likely adjusting risk exposure. The stock is currently down over 6% from its previous close if you look at the wider 24-hour window, and this volatility is largely a hangover from the recent shock of their auditor, Ernst & Young, resigning. When an auditor walks away, it is usually a death knell, or at least a signal of a prolonged freeze in capital appreciation. However, the counter-narrative appearing in the order flow today suggests that some deep-value investors are stepping in at these lows, betting that the company's building block architecture is too vital to the Nvidia stock ecosystem to simply disappear. Now, let's pause and talk about the broader market mechanism happening here. Usually, when you're involved in online investing, you look for clean stories, companies with rising earnings, happy auditors, and clear guidance. SMCI is none of that right now. It is a distress play. The pressure we are seeing on the stock today is also macro-driven. Bond yields are fluctuating, and whenever the cost of capital gets questioned, high-beta hardware stocks like this take a hit. If you were managing a Schwab Intelligent Portfolios allocation, algorithms would likely be dumping SMCI right now simply based on volatility metrics. But if you are doing self-investing, you have the luxury of asking, why? The why for today's drop is a mixture of technical breakdown below the $34 support level and a lack of fresh positive news to counter the auditor narrative. The market hates a vacuum of information, and right now SMCI is silent on the one thing that matters: who will sign off on their 10K. It is crucial to understand what Supermicro actually does, because that is the only reason the stock is not trading at zero. They are not just a generic box mover. Their business model relies on what they call server building block solutions. Unlike Dell Technologies or Hewlett-Packard Enterprises, which might force customers into rigid product lines, SMCI allows hyperscalers, the big cloud companies, to mix and match components like Lego bricks. They can swap out a motherboard, a power supply, or a cooling unit without redesigning the whole rack. This speed is their moat. In the realm of AI, where Nvidia chips updates its chips every year, speed is everything. If you can integrate a Blackwell chip 3 months faster than Dell, you win the contract. That is the bull case that is currently fighting for its life at the $33.37 level. Furthermore, we need to talk about liquid cooling. This is a term you'll hear constantly if you follow Fidelity Investments research notes on the hardware sector. AI chips run hot, extremely hot. Traditional air conditioning in data centers is reaching its physical limit. SMCI has been pushing liquid cooling technology for years, long before it was cool, pun intended. They claim their DLC technology can reduce electricity costs by 40%. In a world where data centers are consuming the energy equivalent of small nations, that efficiency is not just a nice-to-have, it's an economic imperative. This technological leadership is the reality that contradicts the expectation of a failing company. The market expects a financial failure. The reality is a technological leader. However, the weight of the governance discount is massive. The reason you might hesitate to add this to your Fidelity IRAs or your SoFi active investing account is the Hindenburg research report from earlier this year. The short seller alleged channel stuffing, shipping products that weren't ordered to inflate revenue numbers, and related party transactions. These are serious accusations. When the auditor resigned recently, they essentially said they could no longer rely on the representations of management. That is about as bad as it gets in the corporate world. It turns the stock into a binary gamble. Either they find a new auditor and clear their name, sending the stock ripping higher, or they face delisting from the NASDAQ. This binary outcome is why the volatility is so high today. You are not investing in a company right now. You are betting on a court case and an audit outcome. Let's step back and look at the sector momentum. The semiconductor space is a bit mixed today. Nvidia stock is down slightly, about 1.8%, which acts as a drag on SMCI. Since SMCI is essentially a downstream derivative of Nvidia's success, when the mothership sneezes, SMCI catches a cold. AMD is actually up slightly, which is interesting because SMCI just announced those new servers for AMD chips. This divergence suggests that the market likes the AMD hardware news, but hates the SMCI corporate governance news. It's a tug of war between product sentiment and corporate sentiment. If you are using Interactive Brokers trading tools, you might notice that the put-call ratio is elevated, meaning more traders are betting on further downside or hedging their positions than betting on a recovery. There is also the element of retail versus institutional sentiment. If you browse through Robinhood app discussions or SoFi Invest social feeds, you see a lot of retail traders asking if this is the bottom. There's a buy the dip mentality that is trying to fight the institutional sell the risk mentality. This creates choppy price action. You see a sudden pop to $33.40 and then a slam back down to $33.20. That is the sound of retail buy orders colliding with institutional sell algos. It creates a very dangerous environment for individual brokerage accounts that aren't using tight stop losses. Let's assume for a moment you are looking at this from the perspective of Fidelity Wealth Management. Would a wealth manager put a client in this? Probably not right now. The reputational risk is too high. This absence of smart money support is what makes the floor so fragile. Usually big funds step in to defend value levels. Right now they're largely on the sidelines waiting for clarity. This liquidity vacuum means that small sell orders can move the price disproportionately. It explains why we're seeing these jagged 1.5% drops on relatively standard volume. Comment below how many shares of super microcomputer you currently hold, or if you sold everything when the auditor news broke. I want to gauge the sentiment of the room. Now, let's analyze the competition. Dell and HPE are the predators circling the wounded animal. Every day that SMCI spends fighting accounting allegations is a day that Dell's sales team uses to steal market share. Do you really want to buy your mission-critical AI servers from a company that might be delisted? Is the easiest sales pitch in the world. We are seeing data that suggests Dell is picking up orders that might have gone to SMCI a year ago. This is the fundamental erosion risk. Even if SMCI clears its name in 6 months, they might have lost key relationships that are hard to win back. In the